joining us. It's with great pleasure that we have for you today a 1-hour webinar with the team at Project Delphi, or Delphi as might be the preferred pronunciation. At any rate, Network for Sustainable Financial Markets is extremely excited to be providing this to its participants. We have with us 4 members of the team that's been working on this important investor-driven project. We have Ralph Frank from the DBFA. Many of you will know Ralph. John Swanick, Chris McNett from State Street, and Mike Polia from State Street. So what I think we'll do today is we'll have an overview of the Project Delphi, where it's at, and we'll have a chance to get some questions at the end. So without further ado, over to you guys.
Hi everyone, this is Mike Polia. I have the privilege of leading this fascinating project and of working with a stimulating group of ESG and investment specialists. The project has been underway for 3 years now, and we believe through a sometimes arduous process of consensus building, we've arrived at something pretty unique. And the reasons for saying this is because it is based on, firstly, based on financial value drivers linked to enterprise profitability. It's investment industry focused. It's collaborative with approximately 45 different organizations taking part, those being asset managers, sell-side investment banks, pension funds, academics, consultants, federations, many different groups of people. And fourthly, it is parsimonious. We've tried to focus on the most significant factors and metrics in this ESG puzzle. So I'll give you a brief introduction to the conceptual background of Delphi, why it is different, the mission, and how we will engage with the intended audience. Ralph Frank will look at the differentiators, how we define ESG factors and materiality, how we have adopted the principle of parsimony. Chris McNett will talk about our value driver logic, and then John Swanick will take us through a more focused overview of the framework. Project Delphi was born from a desire to reach a consensus on which are the really important ESG factors and metrics that have the potential to move the dial in terms of value creation and risk mitigation. It's a project sponsored and coordinated by State Street Global Advisors, but it is a collaborative project with 45 participating organizations. ESG is really shorthand for an approach which can help identify companies with superior business models and which therefore have the potential for longer-term value creation. We've avoided the inclusion of values-based factors, such as may be found in more traditional SRI or ethical investing approaches, unless there is a demonstrable financial impact. Our mission today is to give you a brief insight into Project Delphi, but also to ask for your help. We're going to share the framework we've been developing over the last 2 to 3 years, the framework of metrics for measuring performance in a range of ESG factors that directly relate to value drivers and in turn key value levers. The majority of the work has been undertaken by the Delphi Technical Group, drawing on the knowledge and expertise of a wider group of Delphi participants from time to time. We would like you to be part of the testing process which we are undertaking by giving us your feedback on the framework and the ESG factors and metrics contained in it. But we want this to be an ongoing dialogue. That is part of the dialectic. We've taken nearly 3 years to get to this stage because the process has been dialectic, iterative, consensual. The slide 4, we can go back, yep, that's it. Slide 4 shows the list of participants, and as you'll see, we've really drained some of the best brains in the market with long experience and access to the best research. But now we have a product for testing and we need to expand the gene pool. So all contributions will be welcome. We have members of the technical group on the call today, and I hope they will feel free to interject as necessary. We also have members of the wider Delphi family, and we have some participants who are neither, but whom we hope to engage more fully going forward. The next slide, our mission. The mission. Delphi's critical mission is to help build a consensus around ESG as a key determinant of corporate value and create an industry platform that adequately incorporates ESG into investment models and investment decision-making. This means for analysts and researchers, it's helping to scope the material issues by industry and the analysis and research needed to inform asset managers' new valuation approaches and investment models. For asset managers, it's promoting greater recognition of the critical ESG issues and the information and data they need to revise valuation approaches and develop new investment models. For asset owners and their advisors, it's increasing understanding of the value implications of ESG investing and the priorities that would be setting asset managers. We believe that ESG is inadequately valued by the industry. One reason, of course, is skepticism at the contribution of ESG factors. A second is the inability or unwillingness of the industry to incorporate value drivers that cannot be quantified in financial terms. But there is also the widespread perception that ESG proponents are unable, unwilling, probably ambivalent to link ESG factors to value drivers and identify which ESG factors are the most material. Delphi was convened to do that and create a consensus around the results. Consensus within the industry, but also to help create a platform for productive dialogue with companies in getting to the required data. So beyond the framework, the broader agenda, we are at the end of the beginning. We've developed our first version of the framework. The outreach is partly promotion, partly consultation. Fundamentally, it's about engagement. That engagement will be a series of concentric circles. We are investment industry-led. Our primary engagement will be with the industry, asset managers, asset owners, and their consultants. It will be with analysts, fund managers, decision makers, advisors, and commentators. But we will also bring in the corporates and their advisors, the accountants, management consultants, and those who facilitate the dialogue with investors. And we will engage also with those who set the parameters of that dialogue, the regulators and policymakers. Now, it is with pleasure that I hand over to Ralph, who will tell us something about what makes Delphi different and how we define our ESG factors and materiality and so on. Ralph, over to you.
Okay. So I guess we've had the beyond the frame with broader agenda. Can we have the next slide, please?
Next slide. That's it.
So the first, can everybody hear me?
Yes.
Okay, fine, good. So what makes Delphi different? There's a couple of aspects which you should know about Delphi. Materiality is one of these key and buzzwords if you speak to those who provide assurance to company CSR or sustainability reports. Materiality we define as something that needs to be based on robust assessment, and you'll see later what we mean by robust assessment. We have applied a specific logic, that is ESG factors are linked to value drivers, and Chris is going to speak about that later, and linked to financial levers. We think that if you look at ESG, it's got to be done in a well-structured framework. Now, my favorite subject, as everybody knows, in Delphi is parsimony. We've tried to identify the most material ESG factors by industry. Let me just elaborate a little bit on that. If you look into specific company reporting frameworks, and I suppose even EFAS, my own organization, has been found guilty of that, we've included far too many ESG factors. Now, it's not really it's not really convincing to assume that in the area of sustainability or ESG that you would need 30, 40, 50 specific factors to assess whether a company is a sustainable investment or not. Then something we've applied for those of you familiar with XBRL, Extensible Business Reporting Language. We thought that our framework needed a taxonomy. So the taxonomy says what is a factor, what is a ratio, and the taxonomy as such focuses on the quantitative, which makes a difference. We're not saying that qualitative information is not valuable, but in order to integrate ESG into mainstream investment decision making, and I suppose that's what Delphi is about. We need to focus on the quantitative because at the end of the day, any type of factor will have to go into a model or a calculation or a spreadsheet or whatever else. Then, very important, it's those factors which we deem important and relevant need to have some sort of predictive capacity. So it is, as everybody knows, especially if you're looking at equities, it's the future performance that you're after, not just the historic reporting. And finally, we've all seen that frameworks such as G3, who's now become G4, and even the FS framework, and I suppose the same will hold true for SASB. It will have to undergo a regular updating because the world is moving, and we wanted to create a platform that enabled us to update, so that something that has become, you may know the term that accountants often use, that new items enter the scene from the margin and then they become mainstream. And if something becomes mainstream, then suppose it doesn't have to be part of the Project Delphi as such anymore, because it has become part of the investment, classic conventional investment decision making, or as some critics would put it, investment folklore. Next slide, please. So here are a couple of definitions which are very important. When we started in the work within Project Delphi, we noticed that there wasn't one standard definition of what is an ESG factor. So we sat down to define one, and you may disagree with that one, but that's the one that we've used. We said that within the scope of Project Delphi, environmental, social, and governance issues were defined as related to those factors relevant to the understanding of a company, which help to assess company's capacity to remain productive over time and its potential for long-term maintenance of profitability. And that's then those hyphenated items in the bullets at the bottom of this slide show you what we mean by that. That's the responsible use of natural resources, and that's including the value chains of companies, respecting social norms, and being accountable to providers of equity and debt capital. Now, please note, to some SRI investors, this type of definition would probably be too broad or a little bit too much focus on the mainstream, but we thought that's the way it ought to be. Next slide, please. Materiality, we've given some thought to describe what is materiality. If you speak to accountants, I must have mentioned that before, if you speak to accountants, they have specific rule of thumbs to define what is material, and often the rule of thumb is simply because the company or the issuer says so. We thought that wouldn't be enough, so we sat down to come up with a definition that says an ESG factor is considered material if it first has a high probability of having a financially material impact on the defined value drivers of investment, then allows prioritization of issues for investment decision making, see that it's based on research or sufficient evidence on its impact, and that's something where you if you carefully study the literature out there, and often if you study the explanations that companies come up with, is often not based on research or sufficient evidence. Then it's got to be rigorous, i.e. replicable, defensible, and credible. Needs to be practical, simple enough to be widely used and communicated. We all know that not every ESG factor can be as easy and simple as, for instance, carbon is, but nevertheless, that's one of the goals. somebody fell off their chair. And finally, sophisticated enough for the needs of investment decision making, and that is what I said before, including modeling, calculating discounted cash flow, net present value, WACC, or whatever else we have in terms of models. Next slide, please. So, well, when it comes to the test, then in terms of parsimony, we've followed, as you can see, the industry classification benchmark, which used to be the Dow Jones, is now the stocks industry classification benchmark. These are the 2, 4, 6, 8, 9, 10, 2, 4, 6, 8, 10 industries. And you can see then the number of factors identified for these industries. And I'm pretty sure you'd say that this is a small enough number to be used for models. And again, when users of the Delphi factors look at these factors, we're pretty sure that some of them will sort of favor one over another. So in the end, you might end up with something that's only 10 or perhaps 8 because you consider these 8 more material than the other ones. But the framework per se today has only these numbers of ESG factors, which makes a huge difference to some of the frameworks out there. Next slide, please. And I guess it's now over to Chris.
Yes, thank you, Ralph, and many thanks to the network for hosting us today. So those principles that Mike and Ralph spoke of are central to the logic flow of our framework, and is based on a recognition that across industries and markets there are indeed some fundamental drivers of value and risk which are not captured in the financial statements by and large, or in the majority of valuation models, primarily because they are not captured in the financial statements as they stand today. And those value drivers are influenced to some greater or lesser degree by ESG factors, which in many cases will be more industry or market specific. So again, we aim to highlight those which have a greater degree of influence, judged either by frequency or quantum, or both in some cases. And the ESG factors that we have arrived at can be represented by bundles of individual performance metrics, which are related to aspects of the factor that are defined and quantifiable at a company level. And John will come to that in a few other pages down the line, as that is mostly but not always the case, of course. But what we have is metrics which define the factor in predominantly quantitative terms. So as Ralph mentioned, think ratios and units of measurement such as volume, percentages, currency, etc. And not every value driver is applicable to each industry, but every value driver will have one or more ESG factor linked to it. And likewise, not every factor is applicable to each industry, but every factor will have one or more metric, and so on. And you'll see this illustrated in the ensuing pages. Next slide, please. And to some extent, we were informed by the precursor Project Delphi, which is the laboratory on valuing non-financial performance. Some of you may be familiar with that, and that laboratory derived a framework based on its own research into the key non-financial drivers of value, which were then overlaid onto a classic financial driver model. Many of you will certainly be familiar with the value driver model developed for UN Global Compact LEAD and PRI, and that is based largely on a generic model developed by McKinsey and used widely in many different circumstances with their clients and publications. So versions of this value driver model are in widespread use already, both across the investment industry and within companies, and we felt that model provided the basis for broad consensus, fundamentally because questions can be answered and challenges can be solved by properly framing them. And having a structure already well understood seemed like it would have a grounding characteristic to it and act as a binding agent to ensure some consistency across industries, but importantly also be flexible to value drivers, flexible to time scale, flexible to interpretation, etc. Next slide, please. So these models already in use certainly required some adjustment. We have not tinkered with the value levers, not materially at least. The focus in our framework is meant to be on how and where ESG performance influences economic value that is recognizable in standard terms. We have adjusted the value drivers. For example, we have omitted access to financial capital, a central requirement for business continuity and growth, of course, because we couldn't demonstrably link ESG performance to access to capital. But that could change in the future because there is certainly some intuition that ESG performance may link to access to financial capital and emerging research in that regard. And certainly there's a good amount of research looking at ESG performance and the cost of capital. But by the time we had developed our approach to the value driver model, we had really already begun an extensive materiality analysis of the spectrum of ESG factors identified both within our metrics group and an asset managers group. And the derived ESG factors from that exercise both informed and were informed by development of the value driver model that is shown here. And these parallel developments were mutually reinforcing. We have sought and really continue to seek to link ESG to business performance rather than going the other way, i.e. forcing business model terms into ESG terms. We instead put ESG into the business model, much like the value driver models that many of you would be familiar with already. And whatever the precise model, the objective is similar, which is a framework to map sustainable value. And that's what we've attempted to do within Delphi. And John will now take you on a little bit of a deeper dive into what the framework looks like at present.
Chris, thanks very much. So yes, it falls to me to give you a very brief overview, a truncated overview of the Delphi framework. Truncated because for parsimony's sake and also just technical capability, it's not possible really to demonstrate in any meaningful way in this format the logic narrative that we've been developing for each and every line in this framework. But if I can spend just a little time going through what we're showing you on screen here to pick up and pick out some examples to demonstrate how we've developed our thinking, and to highlight some of the issues that we have been confronted by and to be confronted by, and this is very much why we hope that beyond today that you'll be willing to join with us in this enterprise in order to develop the thinking and the output further. So the slide there is one of a snapshot of part of the framework. You'll see the value lever on the left-hand side, value driver, and then ESG factor. And then moving to the right, we have the individual metrics that have been identified through a process which I'll elaborate a little bit more on already. And then moving through to an indication within the 10 industries which are considered in our materiality analysis to be material for that industry. So in the interest of time, I'm not going to go into a huge amount of depth, but hopefully we can pick up any specific issues that you may have in the questioning and discussion later. But as Chris has explained, the factors with a critical element were derived independently of the development of the value driver model. So they were brought together, and the ESG factors were brought together and identified and put through a rigorous materiality assessment so that the material factors were identified for each industry. We then looked beyond the factors at the metrics that best reflected the aspects of the relationship between the factor and the value driver we were seeking to identify. So in that sense, the materiality of the metric has also been assessed. But we also took into consideration a number of other issues. How do we rank predictive and performance measures? Are we prepared to work with metrics that are indicative or even proxies for the metric that we really need? How robust is the metric? How consistent will the measure be over time? How quantifiable is it? If it's not sufficiently quantifiable, do we adopt a lower order metric instead? How do we deal with factors where we simply cannot identify a quantitative metric? Do we adopt a qualitative metric, or do we amend the factor? What data is available, and how widely is it available? Are we interested only in company-generated data, or do we accept industry or third-party data? What about data that is composited from several different sources? Indeed, what about composited metrics? And those are some of the issues that we've grappled with, and I'll try and illustrate what I mean within those by some examples. Given the process by which the factors and metrics have been derived, linked to value drivers, and reviewed on an industry basis, we said earlier that this has thrown up issues dealing with the strong cross-cleavaging thematic issues that have emerged. So it also leads us to question, are these factors sufficiently ESG? So I'll go through and I'll pick up a few of those. We can move please on to the next slide. So we've just taken that previous slide, I've exploded out a couple of lines there that you can see hopefully a little more clearly. So the growth driver here is, the value lever here is growth. The value driver, I'm looking at as the top line, is customer strategy and market share. And then we've identified the ESG factor of customer satisfaction and retention, and two metrics, churn rate and net promoter score. Churn rate is a performance measure. Net promoter score is indicative of future performance. Net promoter score is indicative of churn. Both are influenced by customer perceptions of the ESG performance of the business. So there we have two metrics for the one factor we see operating in tandem, with implications for time lags and continuous measurement, and the difference between performance and perception. So we'll move on to brand and reputation, see further down. Two metrics there, brand perception and reputation. Sorry, the two factors, brand perception and reputation. The allied metrics, proprietary brand valuations and public opinion. Both those metrics, the data for which we know are derived from third-party data. And we know that clearly there are limitations with both. The proprietary brand valuations, and there are obviously several that are well known in the market, have methodologies which are often questioned or insufficiently understood. And we know that there's limited availability. We also know that in many of these, the market-leading brand valuation models, that they only look at a certain number of companies. When it comes to public opinion, in many markets there are omnibus public opinion surveys published on a regular basis by the big polling companies. We also know that companies commission their own public opinion surveys and polling. And the companies also are increasingly using more sophisticated methods of measuring reputation, such as RepTrack. But these surveys, this evidence, this data is rarely published, and not widely available. But should that stop us seeking that information to feed into our assessment and evaluation of companies? We'll move on to the next slide, please. One of the lines, one of the factors we identified is strategic innovation. Strategic innovation as an ESG factor. We believe in our discussions that this is critical in companies' ability to deliver new ESG products and services, to develop new markets and ultimately new business models. But how do you measure it? What is a capacity to develop new business models? No one is yet measuring that explicitly. Implicitly, it draws together a number of standard metrics which are reflected already in our framework. So for example, here I've sought to show the capacity for an investment in research and development, developing talent and skills within the business, the ability to retain the right people and the right skills and the right knowledge, and a motivational culture inspiring people to go the extra mile in developing new thinking. So those factors, those metrics are already embedded within our framework. There are some aspects of strategic innovation that are not, and there's an area we are developing and continue to develop. The cultural impact of leadership, for example, and it's the incubation of innovative strategic thinking is an area that we've yet to really cement into the framework. We'll move on please to the next slide. You'll see from the earlier slide and this slide that employee-based factors are split across two drivers and two levers. The earlier slide showed access to labour as a resource, as a potential growth constraint. But also human capital is also a determinant of future returns. So we show it on this slide under that value lever. Here we've identified all the all-encompassing scope of a number of critical factors such as employee engagement, which is again cross-cutting and cross-thematic, and the number of metrics reflecting the convergence of issues around employee engagement and the now increasing consensus around what employee engagement is and how it's best measured. So it's no surprise that employee engagement is widely reported, but that's something we'll look a little in depth in a minute. But there are other issues where in our framework we're still developing that cross-cutting thematic approach. So you'll see here, for example, in about the middle line there, in terms of environmental factors, and particularly climate change and climate change strategy, and how we can better reflect those things within our framework. So here under resource efficiency we talk about environmental emissions, clearly a theme where there's been lots of debate within our groups around how we can better show climate change and how this can be better reflected. So even if the emissions metrics are the right ones, and it's not my expertise, I have to say, so I mean, these are the ones that we have in our framework at the moment. But how do we then link those to wider themes and wider issues within the framework more clearly, retaining the link between the factors, the value drivers and the value levers? So we can move on to the next slide, please. So I mentioned, employee engagement is one where probably of all the factors we've identified, it's the one that has been deemed to be material for the most industry categories. In fact, I think it's material for all of them except one, that were deemed in our materiality analysis to be material for all but one. And This is not surprising. I mentioned there is clearly convergence now around methodologies for measuring employee engagement. There is widespread acceptance of the business case for employee engagement and its direct and causal linkages to business performance. So when the business case is clearest, there is seemingly no difficulty in creating convergence and consensus around the right metrics. So even within the different proprietary employee engagement measurement models, there is a growing convergence around similar question sets. And now as we move into increasing use of these measurement models, not just annually, but quarterly, monthly, and in some cases now the development of employee engagement pulse measurement, literally on a daily or even hour-by-hour basis. The growth of the big data world is with us in terms of employee engagement. But also, conversely, it's a notable trend that apparently the evidence seems to suggest that as the sophistication of measurement grows and the use of these frameworks is developing within businesses, that actually the public reporting on this has actually fallen. And that seems to indicate that as the data quality becomes better and more indicative of issues that may not be so beneficial for the business to broadcast, that actually their willingness to report on these issues externally seems to be reducing. Those trends are reported as questionable, but I think it's interesting nonetheless in terms of the whole issue of data availability. We move on to the next slide. Clearly, for ESG, an ESG framework, the risk issues are very important. And here, this is one of two slides showing the risk factors we've identified in the allied metrics. Risk processes are meant to capture a range of different factors that are indicative of performance management, covering a number of risks. And so, for example, in terms of the risk processes, the efforts to better manage, for example, ISO performance as a process improvement process are proxies for management of ESG risks on a wide range of different issues across the different industries. So we're not defining what an ESG risk is, but looking at the process by which they're managed. And we are grappling with the issue, not just in terms of ESG risk, but also in terms of the consumer perception, for example, in terms of ESG products, what actually constitutes an ESG product. Here, what is an ESG risk? We haven't sought to adopt or even promote any type of standard definition, but I think these are issues that we need to, as a community, to look at more deeply and to make a defined position on this. At the moment, we're looking at terms of how these things are managed, and rather than the actual definitions of the risks themselves. If I move on to the next slide. So this is the second set of risk factors and the metrics. And the one I want to pick, and I think is probably the most obvious, and it's perhaps a little contentious. It's probably, I'll move on to the next slide, and looking at the corporate governance. It's an issue we've grappled with on a thematic basis. And I know there are a number of people on this call, no doubt, who are very concerned with corporate governance issues. We have adopted a very parsimonious approach to this, a little like iterated earlier in terms of looking at ESG risks. It's about the way in which corporate governance is implemented, rather than about defining the characteristics of corporate governance, because that, I think, would be a whole separate framework in itself. But I think the most important things here are the issues that are deemed to be most material, and all the evidence so far in the research seems to indicate that in terms of materiality, these are the three factors that are most related to performance and returns. And one particularly in terms of policies and procedures. A rather woolly metric, was something we're grappling with, but in terms of implementation, the research clearly shows that the better and the more fully that there is a better management of codes of conduct or codes of ethics, the more strategically they're implemented, the more fully they're implemented, the better the result, the better returns and the impact they have on business performance. And I think that's the focus. So in terms of defining what the corporate governance issues are is not for us at this stage, but it's the actual management and implementation of the processes and the management procedures that is really the focus, because that seems to be where the value is driven. So that's basically the overview, very brief traipse through the framework. If I could ask to move on to the next slide. I think, Ralph, are you going to pick up?
Yes, I can.
We're having yeah.
So in times of integrated reporting and in times where many of those conventional, which we call conventional or mainstream investment professionals, are wondering how to integrate ESG data into their spreadsheets, we think that the framework, the Delphi framework, should also provide an answer as to how to actually integrate the quantitative elements into the classic, if you want, investment making decision framework, where you have ESG factors that have an influence on impact on the classic P&L or items from the primary financial statements, such as revenues, costs, cash flow, net present value, and so on and so forth. That is something that is not just a future vision of Delphi, but we would hope that those investors working with Delphi and those companies obviously endorsing Delphi and producing the type of data that fit into the ESG factors, that we all work together on developing something that we call an integration narrative. In other words, how do these factors at the end of the day integrate or drive items such as revenue? I mean, there's a classic view on ESG factors that says even without sustainability reporting for some of these factors and some of these ESG factors we have identified, you would be able to report them as a company out of your classic P&L items if you want. So for instance, by disaggregating revenues or R&D costs, and you will find that some of the factors in our framework already are closely linked to those factors in the P&L, the cash flow statement, or the balance sheet. Next slide, please. Also, the classic way of looking at companies in our industry is to look at them within an industry or an industry peer group. So you have, in one bucket you have pharmaceutical companies, in the next bucket you have chemical companies, and then you have utility companies. Delphi renders itself also to a different approach, in which you tend to see companies from several different industries as having similar risk profiles. For instance, if you imagine a company that has some sort of production side, there's a supply chain, logistical operations, employees, and you might then compare, for instance, companies from the production sector with companies from let's just say from the services industries, and we feel that it is about time to also think and perhaps make selections in terms of stock picking, if you want, or in terms of asset allocation, by looking at risk profiles rather than just industry profiles. So that's just a quick outlook into what will be next within Delphi and what Delphi can do to our industries. We hope that some of the stuff that we presented to you today was thought-provoking, and I don't know, I guess we have time for a couple of questions, and I'd say over to you, Kerry.
Yeah, thank you. Thank you so much, guys. That was really great. So I just have a couple of things. First of all, if anyone on the webinar has a question, please just mention that in the chat box, and please mute yourself if you're doing that, because the typing noise might come through. Just let us know if you have a question, and we'll turn it over to you. But I have one question to start, if I could. Having been the person who wrote the case studies for the value driver model project that the UN Global Compact continues to work on, if anyone's curious, you can just Google value driver model, and you can see the 30 company case studies that we did. But I'm mentioning this specifically because one of the things I think we lack in our field are really good investor case studies. So my question would be, for example, John, you were talking about the importance of employee engagement, and in 2014 we saw the best performing SRI fund in the U.S. was a workplace fund. So there's a great example of a fund manager benefiting from looking at this sort of value driver. But I'm curious to the four of you, is there something in particular that excites you about investors using this information? Are there anonymous case study examples you could give us of how the investor world take this sort of information into account? I get so maybe John, do you have is there to start, or Ralph?
Yeah, well, I'll start and what the others are thinking. A lot of questions there. I mean, I think that certainly in terms of the research, there is a lot of directional evidence on an increasing number of the factors and their relationship with financial performance. There are very few where a direct causality has been established, and I think that's the problem. And of course, and to a certain extent, it's something of a holy grail. I think probably employee engagement is where it's come closest, and in fact, I think there's probably a very strong body of evidence to say that there is a direct linkage between employee engagement and financial performance through not just better employee motivation and performance, but also through the impact on customer perception and delivery, just the straight delivery of sales and revenue. Similarly, I mean, there is enough evidence, I would have thought, for the impact of customer perception on performance and the consequent contribution of ESG factors on customer perception. And I think as we grow into the world of the big data, I think those factors are going to become more and more apparent. I mean, certainly they're very evident in key B2C markets. I am constantly told by those colleagues in chemical industries and extractives and so on that it's just not relevant in the B2B world. But I dispute that, because clearly in those worlds you have a small number of relationships of mass, which probably are more like partnerships than customer relationships in many cases, although I'm not naive enough to not realize that the price plays a very important factor in that. So there are certainly two there, and the third, I think, I mean, clearly is on the corporate governance side. I mean, that goes without saying that there is, I mean, widely accepted, even within the so-called mainstream investment community, that corporate governance has a critical part to play in determining and protecting business value. I picked up in the slides the area of what is corporate governance and how best is it measured, and there are seamless debates on that, I know. My view is very much that it seems to be, and the evidence seems to show, both in the US and in Europe, that it's the the efficacy of the management and implementation that are the critical things, as much as the actual corporate governance agenda. So there are three big themes there that I think there is a sort of definitive and growing body of evidence, and I think that's also true of some other areas. But I think it is growing out there. What's driving, what will drive further research and development is that development of the initial business case, and in order for people to for the incentive for people to look at it and invest in actually developing that business case further.
And this is
thanks, John.
I just want to pick up on that real quickly, if I may, Carrie, because I think what you've hit on at a sort of a bigger picture level is the development of the narrative to accompany the framework, and that's something that is very much a work in progress, because we recognize that just putting the framework out there by itself doesn't necessarily make it a useful tool without having some narrative to go around it. And the narrative will look at a series of relationships, starting from the bottom, why this metric, and then why that metric relates to the factor, and that factor is influence on the value driver, and the value driver's impact on the value lever. And that is something that we're looking for to develop, and will sort of be part of the go-to-market. So we are very much looking for examples, and we invite suggestions to that regard. And there is also another view that to take it a step further, you could then populate the framework looking at a sample of companies, and then look at those same companies in terms of how they stack up on return on assets and return on capital, valuation metrics, leverage, sales growth, earnings growth, and try and identify those relationships there. And while that certainly would not be, it would be more indicative than conclusive, it would start to suggest some relationships. And I think what we're doing here with Delphi is also looking to the providers of data, so companies, but then also entities like the sell side and brokers, to say, we've come together and we think these factors and their metrics are important, and we want more data, more research, and more analytics behind them. So that's sort of part of the call to action, if you will.
Great. No, thanks, John. And
Kerry, Mike
please,
here.
Yep.
I'd just like to pick up on what Chris said and support that. I mean, we're all conscious of this disconnect between the investment community and the corporate community. The investment analysts feel that companies are not reporting the information they need, and the corporate they're filling in sustainability reports that are not even looked at by the analysts, and so on. So there's that kind of disconnect. And why is it that analysts have not or largely do not take certain factors into consideration? And the issue is, of course, materiality, and that materiality hasn't been proven sufficiently well, and so on. Now, and that is dependent on the data, and we believe that the data sets are getting longer, and that the data is slowly becoming more dependable, and we believe that certain patterns will emerge, and that certain factors will be taken into consideration and will become material. And I think that what we will see, and this is a sort of vision for the future in a way, is that there will be people who use this information and who are successful with it, and success will breed success. And that's really the great hope here, is that once we can get to a level where certain factors are deemed to be material, and where the fiduciary duty is clearly demonstrated, that there's a kind of virtuous circle at play. But we're still some way off that. And at the moment, we're like blind men trying to find the data to support the concepts. But gradually, bit by bit, the pieces will be put in place.
No, thanks, John, Chris, Michael. Hopefully, we'll have a flashlight in the cave at some point on these matters. There's a question from the audience. Over to you, Bill Bowie, if you can ask your question to the group.
Sure. Thanks, Kerry, and thanks to the panelists. I was particularly intrigued by the statement in the description that the Delphi framework also sits at the nexus of the investor/corporate dialogue. And I actually am just coming off facilitating and participating in a week-long online dialogue hosted by GRI and Oxfam about this very issue of aggregating sustainability data, and jumping into another dialogue, separate one that's happening this week on the survey fatigue issue that just got mentioned. So I'm wondering, to what, I'd love to hear more about how you see the framework sitting at that nexus, and in particular, if you are looking at leveraging online mechanisms for conducting that dialogue more efficiently and more effectively.
I'll pick up on that one, if I might. That's my floral language, I have to confess, in terms of the nexus. I mean, my background is certainly more corporate than it is investment. So that to me, that's the area where I think my focus has been historically, is around the communication, or rather the lack of communication between companies and the investment community. And there are a whole range of factors at play here. But I think one of the main ones is the development of a common language. And from that point of view, and my previous role in leading the laboratory on valuing non-financial performance, the language and the dialogue has to be on a common platform. And I can't see any other way that being anything other than financial or linked to financial. And so the materiality is about financial materiality, that the value is about financial value, and connecting those things with the ESG contributors. So that's the nexus. I think the advantage that Delphi has is in terms of its defining characteristics, in that it is what you saw earlier, based on financial money. It's about parsimony and identifying the critical factors that will be recognized and accepted and understood by both the investment and the corporate world. I think the advantage that Delphi has is that it is an investment-led initiative. Its focus and its remit is fairly well defined, and we've obviously hopefully illustrated that for you today. We don't have wider draws on our attention that perhaps is true of some of the other well-known initiatives, where there is the NGO influence and the need to meet the needs of several different audiences outside of the corporate and the investment world.
No, thanks for that. I think that also answers the next question we had from Marcy on the difference between SASB and Delphi, and how can the market discern that difference. I think, correct me if I'm wrong, if anyone wants to add to your comment, that in effect it's the difference is who are the actual stakeholders in question, and in the case of Delphi it's investor driven. And in the case of SASB, it's potentially any category of stakeholder. Does anyone else want to talk to that point?
I'll just say quickly on that, Kerry. This is Chris. That SASB is explicitly seeking to create a standard, and there are official standards, of course, and there are de facto standards. We are not explicitly trying to create a standard per se. We wouldn't object if it was well received in the marketplace and received, substantial enough uptake where it became sort of a de facto standard among the investment community. But I think we're a little bit more humble than that. So ours is also, I think, being a little bit more clear about. And we are hoping that this is a tool, and to use SASB's terminology, a decision-useful tool, but one of many tools to supplement some of the existing processes that are out there, and being humble as well that we are looking for more research to be done to be able to take Delphi and make the link and cross the bridge from a framework like this to an actual valuation model, whether that be discounted cash flow or some other type of model. As it stands now, it doesn't readily lend itself to that, but that is something that we'd like to do in the future. And just quickly on Bill's comment, yes, we do plan to have a online web presence that should be forthcoming shortly, and we are looking to link in with the European Commission in some respects with some of their disclosure directives. So there is some more to be done on that.
Well, thanks, Chris. Just running slightly over, I'm going to combine the remaining questions, if I could, into one last question for the group, and to thank you again, all of you, for joining us. Daniela, two of our board members have questions. Daniela Carosio asks about how relevant are the various factors, and if you think corporate governance is more relevant than other factors, do you envision some use of a higher weight? And then Keith Johnson asks, it appears that the framework is aimed primarily at investment managers with a long-term mandate. Is that correct? Materiality seems to be evaluated at the company and portfolio levels. Could the framework reflect risks and externalities borne by ultimate beneficiaries, for example, corporate political activities? And then finally, third thing, if there's any other way that the Network for Sustainable Financial Markets can be of help to you guys, just let us know. And thanks again.
Okay.
Can I just step in on the one thing, Daniela's question? Is that Chris? Is it okay if I go first?
Please, go for it.
I was just going to answer to the one thing. Is more, Daniela, this is not so much an answer, more an observation. If you speak to those who have been in our markets for, let's just say, 10, 15, 20 years, typically, be it investors or financial analysts, they do have some sort of notion, feeling, perception about corporate governance. And we all know what it feels like if somebody is telling you something that you feel cannot be true or is not quite true. So from our perspective, and Chris, John, and Mike may disagree with that, the classic entrance gate into transporting E&S into a company dialogue and then into investment strategy is if you walk through the door of governance, because many people have a good enough understanding about corporate governance. So it's probably wrong to say corporate governance is more important than the E and the S, especially as for in many markets for the E, you have far better data and a far better understanding how to measure it than you do have for the G. But it's sort of, if you look at it in terms of a sequence, then you might say, start with governance and then try to understand what is the company doing in terms of the E and the S. That's probably the right way forward. And just a quick one on Keith's question on long-term mandate. I would probably say the classic user of our framework on our side, that is investors or financial analysts, is somebody with a long-only perspective, not necessarily long-term, but long-only. Although there is an idea that's been around in the markets for many years that even hedge funds, to use the dirty words, could be quite instrumental in making ESG happen by exerting influence on companies. But I won't go further into that. Chris, and now to you. Over to you.
Oh.
Chris?
Well,
Seems to be
what we're
pretty
trying to find,
clean.
Chris, I just had to add one thing, and it's partially in answer to Keith's question, I think. I mean, it depends if you find long term, and in the long term, we're all dead and all that stuff. It seems to me, I mentioned about the holy grail of the monetizing or valorizing some of these factors, if not all of the factors in our very parsimonious model. If you can do that and build that into DCF models for investors, you could also build it into MPV models for companies and start to actually make a reality of internalizing externalities in the business case and investment case analysis within the business. So not only internalizing the externalities, but also, and this is the challenge, you're also externalizing the internalities, and that would be an interesting world to be in. Chris, are you back?
Yes, I am. Sorry, I was on mute, and I'll say that you guys touched on it well, and in the interest of time, I'll let it lie.
All right.
Great. Well, thanks everyone for joining us for this participant-only webinar. There have been a lot of questions about this webinar. What we're going to do is, as we get questions, we'll just forward them to you guys on the Project Delphi team to make sure that you're hearing directly from the people who have further questions. With that, thanks again so much everyone for joining us, and we look forward to our next webinar. And best of luck with the project.
Thank you.
Thank you, Gary. Thank you so much for hosting us, and we hope you found it interesting.
It was indeed. Thank you.
Thank you.
Bye-bye.
Bye.
Bye everyone.